Greetings, everyone. It is Employment Friday. I know that the title to this week is about OpenAI. That was big news this week. And so we will start out with OpenAI and AI generally, just giving you our perspective on what is happening out there and how quickly it's happening. And then I will go through the usual drill: fiscal policy, monetary policy, economic indicators, market indicators, and then we'll wrap with some innovation. But to set the stage for us here is our special guest, our chief futurist, Brett Winton, who I must say has been devouring everything that comes out on AI for years, but increasingly so recently because so much is changing so quickly. And so we thought we would set the stage here for you in the context of the OpenAI news this week and give you our point of view. So welcome, Brett.
Thanks. Happy to be on.
Yeah, so maybe you can set the stage here, Brett. We'll pull up some charts so that you can do so, and maybe we can have a bit of back and forth about what's going on and how provocative it is.
Yeah, the way I think about OpenAI and the other, call it foundation model companies, Anthropic and XAI, is that this is these foundation models, these AI foundation models are going to be kind of the operating system for enterprise software in the future. So more enterprises will develop their own custom software built on top of AI. That'll be internal software and customer-facing software, and OpenAI has a strong bid to power a large portion of that. And we think that this AI foundation model layer of the value chain is going to be worth between 15 and $20 trillion by 2030.
So Brett, if I can just back up, because I know we've gotten a lot of questions about this. OpenAI, yes, we think it's in a really good position. But as you said, Anthropic, XAI, and Meta platforms on the open source side. So it seems like we're going to have two contenders on the open source side. So Llama 3, which is Meta's a large language model, and Elon Musk has said, I think this week, that he too and XAI are going to move towards the open source model. So I think this is fascinating, having two really more closed source models or closed models and two open source models. So wanted to set the stage there because we're getting a lot of questions. But I think just by saying that, we think this space is moving so quickly that there aren't going to be a lot of players. Is that right?
Yeah, I think that, one, it's so capital intensive, and it has kind of this virtuous data generation cycle where attracting customer attention will allow companies like OpenAI to tailor their services, build essentially software on top of their foundation models that cater to those desires of customers, that then attaches the customers to their platform, and then and they continue on in that way. In the same way that the infrastructure as a service, the AWSs of the world, the cloud providers did. If you think about it, they are selling essentially open source. I mean, they're selling commoditized computers through a web interface. It does not seem that complicated, but over time, as they attracted volume, they created all of these endpoints that people can plug into their service. And it's likely the same will happen in AI land. If you look at the pie chart where we have ascribed value, actually, we think the closed source foundation model layer is going to be worth $15 to $20 trillion. And there's another big wedge that will include kind of the open source, roll your own AI software that could also be worth, at the platform as a service level, of the same order of magnitude in terms of value. And so the very high level thing that we think is going on, and I think it's useful to talk about this within the perspective of the macroeconomic picture, is that there's going to be massive productivity delivery to end enterprises and end users. And that's why we think so much value is going to accrue to these players.
Yeah, and maybe we can skip to the next chart. This gets at that last chart was enterprise value, so what the market is going to pay for these services. This gets to the revenue and gross profit opportunities backing that up. So maybe you can talk a little bit about that.
So the explanation here is we think, so by 2030, outside of China, we're going to spend $30 trillion on knowledge worker wages. So think about that as digital marketers, people like you and me, Cathie, salespeople, and analysts, and so the AI software that those knowledge workers use are going to improve their productivity by 4 to 5 times, is what we think. And that's actually, we think it's going to be more like 10 times, but only half of knowledge workers will have kind of adopted the software. But on average, we think it's 4.5 times across all those knowledge workers. So you'll get a lot more output. You'll get a lot more software being written. You'll get a lot more and better analysis. You'll get much more capital efficient allocations of resources, because you're going to be better at understanding where you need to devote resources given the output of kind of these knowledge workers. And businesses aren't going to pay for the full value of that productivity. Actually, we think they'll pay on the order of 10%. That's consistent with how businesses have paid for software in the past. And so from there, we think there will be a $13 trillion market for AI software as a whole. Now that will trickle down to different layers in the value chain. Some of it goes into the foundation model layer. Some of it goes into straight to AWS. Some of it will be businesses buying their own in computers to run their own models. And so the net of that is, we think, between $3 and $4 trillion in revenue will accrue to AI foundation model companies. And then you can pick your margin structure and multiple, but that's roughly consistent with $15 to $20 trillion in enterprise value for these AI foundation model companies.
So just looking at this, the foundation model part of these bar charts really have just begun. The others exist, right? The other parts of the ecosystem exist. They're going to get bigger. But we're starting with GPT-3 ChatGPT, just a couple of years ago. We're starting from nothing and scaling pretty quickly.
Yeah, and part of it is because we think that foundation model companies will actually be taking relative growth from money that would otherwise shift into traditional software companies. And you can already see evidence of this. Klarna announced that they're getting out of Workday and Salesforce.com because they can write their own software with generative AI. And part of the reason you'll get all of this productivity is because software will become a lot more custom and really even potentially generated on the spot for knowledge workers at the time that they need it. How is that going to happen? It's going to be powered by these AI foundation models. And so in some ways, a world that is going to grow a lot in terms of the amount of software out there, it might not be as good for the end software providers as you would otherwise think, because the cost of generating software is going to collapse so completely.
Yeah, and I guess one of the topics that we spend a lot of time discussing is the secret sauce. And I think you've added more perspective to that discussion with this chart. So maybe you want to explain what's going on here.
Like call it a debate out there, which frankly, it's a debate, but I don't think it's actually much of a debate. But people are saying, well, is AI really disruptive, or is it just going to be something that makes Apple stronger and Google stronger, and that's it? And our view is disruptive innovations have 3 common characteristics. They have very steep cost declines, they cut across sectors, and they're themselves platforms of innovation. What's really interesting in the AI space about cross-sector technology, it clearly applies for Tesla in its cybercab effort, for all of the multi-omics companies that we're looking at. We're focused on the way AI is going to accelerate and make drug discovery more efficient, and the way in which AI makes multi-omic tools more powerful, because you can actually interpret the information coming off of them. And there are much larger pockets of data in these other sectors outside of traditional tech. So in this chart, we're showing that Llama 3, which is the largest open source model, was trained on 15 trillion tokens. Think of these as little parts of words. If you look at all of the data that's being generated on Facebook and Instagram, they have 40 times more in image and video. So language is actually a really small slice of the data out there. But then if you look at Tesla's driving fleet, they're collecting, or they can collect, they have the option to collect video and telemetry data off of all their vehicles in fleet. And that's 400 times larger, generated annually, than what was used to train Llama 3. So there's literally quadrillions of tokens being generated. And in Tesla's case, we think hundreds of quadrillions of potential tokens that they could access, compared to 15 trillion used to train these most powerful models in the world. And we think macroeconomically, actually, autonomous robotaxis is a much more meaningful advance, potentially, in terms of how it'll be measured into the economy, than even the language models that we're seeing today. And the same is true for in the genomic space. Genomics is famously very data intensive. If you look at Llama 3 again, 15 trillion tokens, the largest public genome data repository, if you converted it into tokens, has almost 40 times more data in it, but that's only on 500,000 patients. And so you can imagine if we get to a space where we are sequencing, doing whole genome sequencing on every baby that's born, which is probably something that we're going to do, because you'll get a lot of health insights off of that, and know that if there's a something that we need to be concerned about for a baby, then that'll massively expand the data set. And so it's possible that actually some of the most powerful AI companies do not grow in the traditional kind of tech mega cap ecosystem, but come from outside. And so that's part of why we think Tesla is the largest and most practical AI company in the world.
Yeah, I have, as we have been debating this over the last few years and discussing it, it has struck me that Elon Musk has amassed or created a number of companies that are themselves creating a lot of data from different angles, including biological data, Neuralink, and so forth. So he and his companies may be in the best position from a data point of view. Think about the autonomous driving miles, of course. Yes, the biological data in Neuralink. You've got X, the data that has been spewing out of X, formerly Twitter. And so XAI is going to have an incredible wealth of data that many people worry is going to be in short supply for some of the other players. So it's going to be a very interesting opportunity going forward. So we've got the autonomous mobility as, yes, the largest AI project on Earth, $8 to $10 trillion in revenue in the next 5 to 10 years, half of that going to these platform companies. And then you've got, yes, the biological opportunities. We're only now unlocking the secrets. We're decoding life, health, and death. And we're also, with that knowledge and that data, using it to cure disease. And it's amazing how undervalued that part of the market is. It's been absolutely trampled by algorithms who are focused on, early stage, not making a lot in the way of cash flow and so forth. But this may be one of the biggest areas of opportunity when it comes to AI, certainly the most profound in terms of curing disease.
Yeah, and I think that there's, sectors that are less efficient actually stand to gain more, which in some ways is obvious. But kind of AI's ability to kind of be compatible with sectors that are riven with kind of your bureaucracy and friction, and erode that friction as they deliver more powerful performance, I think makes the healthcare space particularly interesting, where it's famously inefficient, and you are just now seeing even the FDA or payers approving kind of AI algorithms for diagnosing diseases. And you can imagine from a patient perspective, like going back to Google for a second, I think it's 1 out of 14 searches is health related on Google. That's actually a very lucrative pocket of search demand they have, where people are like, I have this spot on my cheek. What is it? And if you search on Google, they always tell you it's cancer. So I advise you not to. But if you actually use a large language model to go through and describe, the test results you get from a doctor, you get a really coherent and cogent differential diagnosis of what's going on and what your next steps are. And so it's a much better experience using AI to understand your own health than we have ever had access to before.
And what I think is interesting about this space is the traditional analysts in the healthcare world are used to the friction in healthcare being, okay, all of the stages of trials, and then you have to go to the FDA, get approval, and then you have to get reimbursement, and it's such a slog. But what I think is going to happen is there's going to be a lot more of a forcing function from demand pull, especially in the cancer space. I know we've probably all had experience with family members or friends who have gotten cancer, and they will go to the ends of the earth to get as much information about it, as well as try and get into trials. They'll really push, I think, this evolution towards really the knowledge-based approach to healthcare, and kind of push the regulatory system along and the reimbursement system, because it's that important. It's life or death.
Yeah. And I think that kind of like these pockets of distribution where AI can be very powerful actually can then become kind of areas where companies can potentially expand. So you can imagine, a company starting at the cancer space where you're getting lots of genomic data, which is actually difficult to interpret. So a doctor will increasingly need AI's help to do it. And so the patient will be able to plug into that AI. And that's potentially where kind of like that health interface will be able to expand, where now you're getting a regular, maybe it's even annual blood biopsy that's an early detection for potential cancers. And how do you interpret that information? It's really important that you get that with somebody that can answer your questions. Well, a doctor doesn't have time for that. So if you have an AI system that can say, oh, this is a sign that there might be precancer, and so then therefore this is your next steps, that both is anxiety reducing for the patient, and it makes them more likely to actually get that test done, because they know it won't just be like, oh, this is a confusing set of results and I have to wait for my doctor and he doesn't have time to talk to me. They'll get the information right as the results come and be able to, ask, okay, so what do I do next? And so it really could change the way in which patients really interrogate their own health.
Yeah. And, we do see a lot of people taking healthcare into their hands, taking more control. They want to know more about it. So I think transparency is going to become more and more important and prevalent in the space. So, okay, Brett, well, very exciting, big opportunities, and we'll definitely keep focusing on the prospects for the big four in the large language model space. So OpenAI, Anthropic, XAI, and Llama 3. And on this debate, or maybe the different roles that open source versus closed will play, or maybe one will disrupt the other. So we've got an open mind as we think this through, and we'll let the evidence move us forward.
Great. Thanks for having me on.
Yeah, thank you, Brett, as always. All right. Now we'll go quickly into the economics, starting with our trusty chart here. You can see inflation has broken down. This is the green line, and for those who haven't been tuning in, the purple line is money supply growth over the last 10 years. And you can see the burst during COVID and the unwinding after COVID. You can see the correlation between money growth and the CPI inflation rate. You can also see that in the last year and a half, until recently, it seemed like the inflation rate was stuck around, well, somewhere in the 3.5% to 4% range. Recently, it has broken down below that. It's broken into the twos. And if the money growth rate is any indication, it will continue to come down. Now, I realize we're in a moment where there's geopolitical risk involving the Middle East, and oil prices are backing up. So maybe we go through, another moment of uncertainty here. But if we're right on what's going on out there, listening to company earnings, it does look like that companies are now starting to price more aggressively because the consumer is demanding it. And so we're seeing the discounts on autos go up fairly dramatically. And we're hearing the big retailers, Walmart, Costco, Target, all talk about cutting prices. So we think that on balance, the CPI inflation rate will continue to fall. We wouldn't be surprised to see it go into negative territory, much like it did in 2014 and 15, and then again in 20. Certainly the money growth rate is pointing us in that direction. I didn't go into fiscal policy as a starter, which I usually do, went straight to monetary policy. And that's because the election is close at hand. The government has not been shut down, and there's gridlock, and we will probably be able to say more about fiscal policy in the months and years ahead once we see the results of the election. Monetary policy is different. Chairman Powell's going to be there, before and after the election. We don't know for how long. I think his term is up in 2026, but he is appointed by the president and approved by Congress. So we'll see what happens there. Anyway, so this is money supply and inflation leading indicator. Happy to see the resolution to the downside. I know we've seen a lot of doubters about that. Actually, doubters saying they thought inflation would reaccelerate. And as you know, we've thought that that's not the case at all. And happy to see, at least for now, the resolution to the downside. Also wanted to introduce another money chart. This is China's money supply growth. And you can see that it has been decelerating quite significantly in the last couple of years. There's been a real crackdown in China, and the property values in the economy has been in a world of hurt, actually. Recently, the government is getting more serious about stimulating, but you can see what's baked in the cake here. Money supply growth operates with a lag. So we think it's going to be a while before any stimulus catches hold in the economy. And so we think that the surprises there probably still will be on the low side of expectations. The market is taking off as though, the economy is going to respond right away to the stimulus. That's not how it usually happens. But the market may be right, and by mid next year, China will be on a growth trajectory much different from the one it has been on recently. So let's see, the next chart, also touching on monetary policy. This is the Fed funds rate versus the headline CPI on a year-over-year basis, percent change. And here you can see, well, it's a chart that has influenced me since the early days of my career. You'll see in the early days, in the late 70s, early 80s, the green line, which is the Fed funds rate, went well above the purple line, which is the CPI inflation rate, and stayed above for the most part until the tech and telecom bust. And since then has been at or below the inflation rate until recently. Now it's above, and if we're right, that inflation rate will continue to decelerate, which means that it will go further and further below the green line, the Fed funds rate, all other things equal, which means that Fed policy, real rates, as measured by real rates, is very tight. And I've heard after today's employment report, and we'll get into that in a moment, that a lot of forecasters, strategists, economists are coming out and said, oh no, they cut by 50 basis points. That was way too much. This chart would say absolutely not. It's not too much. In fact, if the inflation rate continues to decelerate to zero or below zero, as we believe it will, then monetary policy will be increasingly tight. And we think the pressures will be on in the economy. So we do expect the Fed funds rate to continue down. I saw the Governor Goolsbee, Chicago, reinforced that the trajectory is down. And what's interesting about that is if the Fed says to us rates are coming down and will continue to come down, then what is the incentive? The incentive is to wait and see how low rates go. Same thing with prices. If prices are coming down and discounts are going up, the incentive is to say, okay, let me see how low is low. So we may still see surprisingly weak growth in the months ahead, and we'll go into that in a moment. I'll just get through these charts for now. So consumer sentiment. These are some of the charts that I go through on many months. So wanted to update before going into the actual rundown of economic statistics in the last month. But here you can see the Conference Board Consumer Sentiment Index, and it's actually Conference Board's Consumer Confidence Index in the green, and the University of Michigan's Consumer Sentiment Index in the purple. The green, the Michigan survey, tends to be a reflection more of inflation than anything else, while the Conference Board's tends to be more of a measure of employment. So you can see inflation coming down has helped sentiment in the University of Michigan survey, although if you look at it in the context of history, this level is still a very low level in historical context. In other words, the consumer is not that optimistic. Now, the Conference Board, on the other hand, because employment had held up so well, at least headline employment, had been looking much better in the context of history. But now we're seeing we're seeing many labor indicators come down. And we're beginning to see the Conference Board break down as well. The latest month I don't think is on here, and it came down fairly significantly. I think it went to 98. Now, maybe now is a good time to take a look at the employment report that came out today. It was much stronger than expected, but as usual, there were puts and takes. I would say on balance, stronger than expected. We had non-farm payrolls at, I think, 254. They were up 254,000. The expectation was about 150,000, and the past 2 months were revised up by 72,000. So upward revisions are a good thing. Now, we had been seeing downward revisions for quite a long time. So this is a departure, and we must take note. I will also say that the indicators that were strong were healthcare, education, government primarily. If you looked at cyclical indicators, exceedingly weak, still exceedingly weak. So that's non-farm payroll. The unemployment rate, so the headline number, actually ticked down from 4.2% to 4.1%. Many thought it would tick up. It did not. And then the average hourly earnings were a bit stronger as well, 0.4% month to month. Expectation was 0.3. So average hourly earnings are going up 4% on average per year. Now, productivity, it seems, is in the 2.5% to 3% range. So what that means is if average hourly earnings are at 4% and productivity 2.5% to 3%, then the underlying inflation rate is in the 1% to 2% range, probably. So that's good. It's good that wages are going up as productivity goes up. Corporations are sharing some of the wealth. On the negative side of the unemployment rate, the manufacturing was down, temporary help was down. Temporary help's a leading indicator, but it's been coming down for a very long time, so it hasn't been much of a leading indicator. Hours worked were down about 0.3%. So that takes away from some of the very positive statistics. And if you looked at the ISM service report this week, employment in that report was surprisingly weak, just like in the manufacturing part of that report. So again, conflicting indicators. In terms of the week-to-week initial claims, those have surprised on the low side of expectations. This week, JOLTS, so job openings, those surprised on the high side of expectations after coming down fairly dramatically. So that was interesting. And I guess the only other variable on the labor side was the Challenger layoff survey. That shot up 53% on a year-over-year basis. So we know there are layoffs. We read them in the newspapers, and they are up 53% on a year-over-year basis. So in terms of, I'm now going to separate just in the last month, just the balancing act that's going on here in the world of economic statistics. So household net worth, the change in net worth, that was up very strongly. The stock market has been up Home prices have been up. Those are the two biggest indicators. Now, if you look at both of those in the stock market, market concentrated towards very few names, that's not a great indicator. We prefer to have it broadening out. And in the housing market, while pricing is up, the actual units sold, units started, have collapsed and have not come back. In fact, I look at some of these indicators, and I started in the business when I was in college in the late 70s, and some of these housing indicators, the home sales, existing home sales, new home sales, they are lower now than they were when I started in the business. That's crazy. The population is so much larger. It's quite shocking. The number of people trapped in their homes by very low interest rates, they can't move because if they do and take on another mortgage, their mortgage rates will go up twofold or threefold, maybe even fourfold. And so that's definitely lowered the velocity of housing. And that's not so great. Also positive, I mentioned University of Michigan survey. Here you can see it ticked up. Again, I think inflation coming down is very important there. We saw retail sales in the month of August, reported in September. They were up very slightly, in fact, probably down in real terms, but they did not fall back much after a very strong reading, the 1.1% the previous month. So we have to put that in the strong camp. Mortgage applications in the housing realm have been moving up quite nicely. So that's a positive for housing. Industrial production was up strongly in this last month. And that's after a significant decline. But the revisions there are now starting on the upside. And then finally, the ISM for the service sector, that was much stronger than expected. Okay, so those are the strong. Now, on the weak side, leading indicators are still falling. They've been falling for, I think, 2 years. Leading indicators, when I started in the business, if they were down 3 months in a row, then the probability of recession was very high. So there is something in the underlying economy that is not well for the leading indicators to continue down. If we look at the personal income and saving, we saw something that, again, I was shocked to see this, the revision so significant that the saving rate went from 2.9%, that's where we thought it was the last time we showed you charts, it's now 5%. I think we have this on the next chart. So it's now 5%. Now we were operating under the assumption that the saving rate was very low, and it's low by historical standards, but it's not as low as we thought it was. And one of the reasons is transfer payments. So government subsidies have been much higher than expected, and dividends. Those were the two primary indicators to revise the saving rate up. When employment starts weakening, which it had been, and may continue to be weak, we don't know, maybe this is an aberration in this last month, the saving rate goes up because people are fearful and they want to bulk up on their nest egg. So it's higher than we thought. And so not as much of a negative as we thought, but it could still go up if there are more insecurities around the labor market. And we are beginning to listen to a lot of companies talking about AI and while they may not lay people off, they may not hire, they'll let attrition happen and adjust that way. And I think that's what is going on right now, given the productivity numbers that we're seeing. Also on the negative side, existing home sales and new home sales, negative. Again, trapped in housing by these mortgage rates. It's a good thing that rates are coming down. We will see an increase in housing velocity, and that's good. We also saw deflation in the manufacturing sector, the ISM prices paid. So that's a sign that not all is well in the manufacturing sector. In fact, most of the cyclical parts of the economy are falling. The service sector is buoying the economy. So we'll see how long this lasts. I'm going to go through a few other charts here and then get into the market indicators and then wind up. So oil prices. What's interesting about this chart is oil prices, given what's going on in the Middle East, and especially involving Iran, I would have expected the oil price to actually spike here. And it stopped going down, but it is not spiking. And it does seem like the demand for oil is coming down. The statistics are being revised down. And we do believe that part of that is cyclical economic activity around the world, and also the shift toward electric or hybrid vehicles. If the geopolitical situation settles down, we would not be surprised to see the oil price continue down in the months ahead. In the next chart, I also like to keep us focused on this chart, which has been a decent guide in a number of ways. So for those of you who haven't gotten the explanation of what this is, the purple line is the metals to gold ratio. And what it's saying here is the metals prices on average are going down relative to the gold price. And you'll notice the gold price has broken out recently. And so we've been forced to ask the question, is the gold price pointing to higher inflation ahead? If it is, metals prices will follow. And here you can see they are not following, at least not to the extent that the gold price has gone up. In fact, they're below where they were, or this metric is below where it was in 08-09, and it's approaching COVID level lows. And what that usually means is a very weak economy. And I do think China is very weak. I think the cyclical part of the global economy is very weak. The green line is the interest rate, very high correlation. Before the Fed started raising rates, as soon as the Fed started raising rates, this correlation broke down. And so what we're trying to figure out here is which of these lines is going to be right longer term, or are they going to meet in the middle and agree to disagree for some time? If the purple line is right, then the economy is much weaker than some of these headline numbers are suggesting, and the interest rate will continue to come down. If the green line is right, then it's basically indicating that the gold price, which has broken out, is pointing the way towards metal prices. So we may see the purple line go up more than the green line goes down, and maybe the green line just stabilizes around here. If we're right about where inflation is going, based on what we showed you early with the money charts, the purple line is probably more correct here. And that suggests that the interest rate should continue to come down. I know after an employment report like we received today, that many people are saying, okay, we're off to the races. The Fed was wrong to cut rates. We don't think so. One thing that we've learned from the last few years is it takes a long time for the economy to react to monetary policy in particular. And monetary policy has been, I would say, what Chairman Powell calls it restrictive. He uses the word restrictive, and he believes it's still restrictive, as do we. So we shall see. I think this chart is a very important indicator. Now, the last chart I'll show you is one that has been puzzling and interesting. This is the spread between high yield bonds and the 10-year Treasury bond in the United States. And when it's below that dashed line, it means that the credit markets are not worried about very much, which is very interesting because we think there's a lot to be worried about. But there is also a lot of liquidity chasing yield. It's chasing yield certainly more than it's chasing the equity market generally, except for the higher yielding stocks. So we're wondering if it's somewhat distorted or if there's very little to worry about. And so you know we will present the positives and the negatives. The negatives suggest, we have worries out there. The geopolitics would suggest we have worries out there. The election would suggest we have uncertainties out there. But since this, I believe, is the last in the know before the election, one thing we do know is that both candidates are basically saying innovation solves problems, and we're for innovation. And the biggest proof point for that is the shift to bipartisanship when it comes to crypto policy, digital asset policy. So that's the last chart. We'll finish up now with market indicators. S&P has been up in the last month with some very strong performances, consumer services, energy for obvious reasons, consumer discretionary, very weak performances from healthcare, consumer staples, and real estate. So those three are considered either safe havens or interest rate sensitive. So big bifurcation in the market. Fixed income, interest rates dropped in September, but are popping back now on geopolitical and the economic report today. Commodity prices broadly went up in the month of September. The Bloomberg Commodity Price Index did go up from 96 to 100 at the end of September and 102 now. But if you were to look at that chart, it has not broken the downtrend that has been in place since 2008, 2009. The gold price has gone up from 2,500 roughly to 2,634, and today 2,645. So safe haven, lower interest rates, probably both. And Bitcoin has recovered. Bitcoin in the month of September went from 59,000 to 66,000 roughly. And we've had a little bit of a setback here as we're testing the lower lows. Let's see if we get below that 58, 59. So this next month is going to be important for Bitcoin as well. So with that, that's a lot in a short period of time. So thank you once again, and we'll be looking forward to addressing you after the election has taken place and sharing with you these indicators. And of course, as always, we'll start with some form of breakthrough in innovation. So thank you very much.